7 business days. That is the total distance between where you are sitting right now and the April 2026 COMEX First Notice day. This isn't just a date on a calendar. Serious. It is a countdown to a structural heart attack in the silver market. Right now, 1,270 contracts are still open. That represents 9.6 million ounces of silver. Somebody, some big institution, some industrial whale, expects to collect that metal in physical form. They want the bars. They don't want the paper. But here's the problem. The vault system just lost over 2 million ounces in a single session last Friday. Concerned. While the clock ticks down, bombs are falling on Tehran. The Strait of Hormuz is contested for the 23rd consecutive day, and the Federal Reserve just told the entire precious metals market that relief is not coming. Silver closed the week bleeding. The paper price touched $64.58. But here is the part that should make you sit up straighter. The vaults are not refilling. They are accelerating in the opposite direction. Paper says sell. Physical says there is almost nothing left to buy. Both statements are true at the same time, but both cannot survive in the same market forever. One of them is lying, and today I am going to show you exactly which one. On March 18th, the Federal Reserve held interest rates steady. That was expected. What was not expected was the signal that followed. One rate cut. That is all the Fed is projecting for the entirety of 2026. Just one. The market had been pricing in at least two. When that dot plot landed, every leveraged position in precious metals felt the ground shift. Silver was trading above $77 on March 18th. By March 19th, it had cratered to $66. That is a $10 single-day collapse. Think about that number. A double-digit intraday wipeout on a metal that was trading above $120 just 8 weeks earlier. The catalyst wasn't a margin hike. It was a central banker standing at a podium and saying the word "one." March 20th brought a brief recovery. Silver moved up $5. Then Monday arrived, March 23rd, and the Middle East delivered a second shockwave. The United States and Israel launched a wide-scale wave of strikes across Tehran. Iranian air defenses activated over the eastern districts of the capital. The Strait of Hormuz handles 20% of global oil and gas. It has been effectively contested for 23 days. Shipping analysts are now stating that transiting through Hormuz is off the charts for the rest of 2026. Brent crude spiked 4%. Then Trump announced a 5-day postponement of strikes, citing productive conversations. Oil reversed violently. Brent crashed to $99. Right in the middle of this geopolitical whiplash, silver was caught in the crossfire. Look at the price discrepancy. Fortune pegged silver at $69. FX Street recorded $64. CBS reported $68. When three major financial outlets cannot agree on a spot price within a $5 range, you are not looking at a normal market. You are looking at a market that is fracturing in real time. The fractures are widening with every session. Let's go underneath the price. COMEX registered silver inventory. The metal actually available for delivery stands at 78.95 million ounces. In April 2020, that figure was above 300 million ounces. That is a 67% decline in less than 6 years. The bleeding has not slowed. It has accelerated. The drainage rate is currently 22 million ounces per month. On Friday, March 20th, the vaults physically added only 41,000 ounces. At the same time, 2.03 million ounces walked out the door. That is a net outflow of nearly 2 million ounces in a single day. At this pace, the COMEX stress index sits at 84 out of 100. That is near its all-time high. The coverage ratio has collapsed to 13.7%. Anything below 15% is considered stress territory. Paper leverage is running at 7.3 times the deliverable metal. For every ounce of silver that can actually be handed over, there are 7.3 ounces of promises floating in the system. The math is terrifying. March 2026 opened with over 10,000 contracts standing for delivery. That is 52 million ounces of silver demanded in physical form against a registered inventory of 86 million at the time. That is a 61% claim rate against deliverable stock in a single month. February 2026 saw the highest February delivery volume in modern COMEX history. January was 7 times the January 2024 figure. The delivery volume more than doubled in a single calendar year, and now April is loading up. Nearly 10 million ounces in potential April delivery demand are already building. If the vaults are hemorrhaging metal and delivery demand is record-breaking, why is the paper price crashing? Look at the managed money positioning. Hedge funds have liquidated 72% of their speculative positions year over year. The speculators ran. Every margin hike, every hawkish Fed signal, every headline about Iran gave them a reason to liquidate. But here is the critical distinction. The people who left are paper traders. They never intended to take delivery. They were betting on price movement. The people who stayed are the industrials, the institutions, the sovereign accumulators. They are not watching the ticker. They are watching the vault. China has changed the game. On January 1st, 2026, China implemented export licensing controls on silver. They elevated the metal to a strategic material. It is now on the same regulatory footing as rare earths. Only 44 companies can export silver. This framework could restrict 60 to 70% of global refined silver supply to domestic Chinese use. The impact was immediate. Shanghai silver inventory collapsed 43% in 4 months. Shanghai premiums over Western spot prices are now $5 to $10 per ounce. The era of cheap Chinese silver flowing west to plug deficits is over. The Silver Institute projects the 6th consecutive structural shortfall in 2026. This is not a blip, it is a pattern. London is telling the same story in a different accent. The LBMA reported that London vaults are losing metal, but the headline number is a lie. A significant portion of that metal is locked inside ETFs and private client holdings. The free float, the actual liquid silver that can be traded, is functionally near zero. On October 10, 2025, the London silver market literally froze for 90 minutes. Not a technical glitch. A physical absence of metal. When it costs 5% just to borrow silver temporarily, the lease rate, the market is screaming. Holders of metal refuse to let go. The gap between paper promises and physical metal in London is the single most dangerous fracture in the global system. Let's be honest. The bearish argument exists. Silver has fallen from $120 to $64 in 8 weeks. The Fed signaled higher for longer. The dollar index is at multi-month highs. Some algorithmic models project silver at $59 soon. The 1970s saw gold crash 50% to shake out weak hands before the final run. Silver's volatility is structurally higher. Its industrial exposure means it reacts to recession fears. The Iran war is creating a liquidity crunch. Even gold gets sold to cover margin calls in other asset classes. That is a genuine trap, but the bears cannot answer one question. Where is the physical silver coming from? Solar panels are consuming record volumes. Electric vehicles need silver. AI data centers require quantities that did not exist 3 years ago. Mine production peaked in 2016. 70% of silver is mined as a byproduct, so higher prices cannot rapidly increase output. Lower prices do not reduce industrial delivery demand. A solar panel manufacturer does not cancel an order because a hedge fund got margin called. The investment channel contracts, but the physical channel does not blink. In January 2026, Turkey imported a record 273 tons of silver. The Sprott Physical Silver Trust is absorbing millions of ounces. This is procurement under duress. This is a two-tier market. While New York quotes silver at $71, physical bullion in Tokyo and Dubai is changing hands at premiums exceeding 80%. The arbitrage mechanism is broken. The metal needed to close the price gap cannot move. China has locked its supply. London's float is committed. COMEX is draining. The mechanism that keeps global prices aligned has failed because the physical silver required to execute it does not exist where it needs to be. I am not in the business of hype. I follow data to its logical conclusion. If the Iran situation escalates, energy prices stay high. The stagflation narrative hardens. In that environment, the Fed cannot cut. Paper remains under pressure, but the physical side does not care. Vault drainage continues. Every dollar the paper price drops, opportunistic sovereign buyers accumulate more metal at a discount. The floor is not set by the ticker, the floor is set by the vault. And that vault is running out of floor. What happens to the paper market's credibility the first time a major contract month cannot deliver? What happens to the pricing mechanism that the entire Western financial system relies on? That is not a question about silver anymore. That is a question about the architecture of trust. Invest with logic, not with noise. Market Crux, signing off.